With stock price returns declining in an unstable market, continued inflation, high interest rates, and a series of chaotic global events, the stock market has been subjected to wave after wave of volatility. The fear and uncertainty fueled speculation about the next potential stock market crash, the first since the coronavirus pandemic began in 2020. Can the market keep correcting itself? Can the stock market continue to rise until the end of 2023? Or could a market crash be on the horizon? Those are questions we don't have entire answers to, but we can take certain actions to cushion the effect of a potential crash in the future. In today's video, we will discuss what the stock market crash is all about, what to do before it happens, and what to do after it happens. Give this video a thumbs up as we dive in. The stock market functions as a large marketplace where people can buy and sell company shares. When you purchase a share of a company's stock, you are essentially purchasing a small piece of that company's ownership. Individuals and institutions can trade these ownership shares on the stock exchange. So when you buy stock, you hope that the company's value, and thus the value of your stock, will rise over time and you can sell it for a profit on the market. As of June 30th, 2023, the market value of all American stocks is $46,199,811.4 million. The market value is the sum of the market capitalizations of all public companies with U.S. headquarters that are traded on the New York Stock Exchange. A stock market crash happens when there are sharp and abrupt declines in the overall value of an index of stocks, or a significant quantity of individual stocks, or simply when the worth of the stock market falls sharply and suddenly. The primary effect of falling stock prices in the immediate aftermath is a rapid loss of wealth for investors. People's investment portfolio values drop, resulting in a decrease in net worth. Investors who see stock prices fall could cut their spending, resulting in diminished consumer trust and economic activity. This can lead to economic insecurity, job losses as businesses cut costs to cope with lower demand and lower profits, and a slowing of economic growth. Crashing stock markets can also have an impact on the housing market. Reduced consumer spending and economic uncertainty may result in a decrease in real estate transactions and, as a result, lower home prices. The stock market is frequently used by people to save for retirement. A stock market crash may put retirement plans in jeopardy and compel people to postpone or scale back their retirement lifestyle. During a crash, businesses with a lot of exposure to the stock market may experience financial problems, which could result in bankruptcies and job losses. Also, there is an increase in panic and anxiety. Panic during stock market crashes is a normal human reaction caused by a combination of psychological and economic factors. During the pandemic in 2020, the stock markets crashed. The Dow lost 37% of its value from February 12 to March 23. The Dow Jones Industrial Average is a daily average of the stock prices of a number of large American corporations. Panic started to spread by the middle of March. Over 20 million jobs were lost, businesses shut down, and the virus spread even as the U.S. was locked down. As investors watched their retirement savings decline by 30% in just 2 weeks, their anxiety increased due to rumors about how much worse things might get. So what are the causes of the stock market crash? There are several factors that can cause this, but I will narrow them down to the most common ones. Speculative bubbles burst. Stock prices can skyrocket when people buy them with the expectation that they will continue to rise. When this belief is broken, it can cause a crash as people rush to sell. Investor confidence. Investor confidence is important. When investors become concerned about the future of the economy or the stock market, they may begin to sell their stocks. Panic selling. When investors panic and sell stocks in large quantities, it can set off a chain reaction. More selling results in lower prices, which can lead to even more panic selling. Global events. Global events such as wars, natural disasters, and political crisis can undermine investor confidence and lead to a stock market crash. Lack of liquidity. In certain circumstances, there might not be enough buyers for the stocks being sold, leading to a rapid fall in prices. Economic shocks, such as economic recessions, financial crises, or unexpected economic downturns, can cause a stock market crash. These occurrences can harm corporate profits and cause widespread sales. High-frequency trading. Computerized trading can cause markets to move very quickly. If these algorithms begin selling quickly, it may contribute to a rapid drop in prices. Regulatory changes. Changes in market rules or regulations can have an impact on stock prices. For example, if margin requirements change abruptly, some investors may be forced to sell. Always keep in mind that a stock market crash is frequently the result of several of these factors occurring at the same time. As a result, it's critical to have a diversified portfolio and a long-term investment strategy to help you weather the storm. Which brings me to the next point. What can you do before a stock market crash to help navigate its effects? Set specific financial goals. Whether you want to buy a home, send your children to college, or retire comfortably, setting specific financial goals means determining what you want to accomplish with your money and when. A stock market crash can be navigated by having clear financial goals. You're less likely to act rashly out of fear when you know what you're investing in. You can remind yourself that your investments are part of a bigger plan and that short-term market changes shouldn't interfere with your long-term goals. Having this clarity will help you remain calm and focused while the market is fluctuating. Create an emergency fund. When the stock market crashes, having an emergency fund gives you peace of mind. You might decide against liquidating investments at a loss to meet emergency expenses when they experience a decline. Having an emergency fund ensures that you have money on hand to cover unforeseen costs without having to withdraw from your investments when their values are down. It keeps you from making hasty decisions that might jeopardize your long-term financial goals. Stay informed. Staying informed entails following market developments, financial news, and economic trends. With more information, you'll be able to evaluate your investments with greater objectivity, possibly decreasing the urge to panic sell. You can identify long-term investment opportunities when stock prices are low by staying informed. You can get legit financial information from reliable media sources, including Bloomberg, CNBC, Financial Times, Wall Street Journal, and Fox Business. They cover financial news, markets, and economic developments in depth. Although they can be unsettling, stock market crashes are a common occurrence in the financial world. You can get through these trying times more successfully by being proactive before a crash and keeping a disciplined approach after one. Comment and let me know what you think of the video. If you found the video useful, don't forget to like and subscribe.